Good morning, everyone. My name is Michael Naidrich. I am the co-CEO of AmeriVet Securities, and as always, I have the great pleasure to be joined by my partner, Gregory Faranello, CFA, all things Fed, liquidity, and rates. Greg, here we are again, another in focus meeting here for the Fed. Love doing this with you as always. Let's jump right into it if you don't mind. Everything about Powell and the presser is in focus. Maybe we should discuss the dynamics of the U.S. Treasury market relative to the war. It hasn't been the typical flight to quality environment that we've seen in the past.
Good morning, Mike. No, that's exactly right. I mean, look, the meeting largely expected unchanged here from the Fed, short-term pause. But the dynamics around the Treasury market, no, I mean, it's not a typical flight to quality environment. I think if you look at it very practically, the reaction function of the Fed within this pocket of time is very different. So, inflation is still running close to 2 times the Fed's target. We have a lot of Treasury supply coming out of the fiscal side of the equation. The Fed is running off their balance sheet. So, typically if you would see a pocket of time like this, yeah, you would expect rates to move lower. And in fact, we did for a short period of time, and then we resumed the sell-off higher. Bitcoin's done well. Gold has done well. You don't need a lot of gold in this environment. We'll see if we break out to new highs with gold. But those have been the flight to quality instruments. And then with regard to treasuries, what you see from market participants is they like to cover up before the weekend and then come back on Monday and start selling again.
Yeah, I've definitely seen that. And gold is back in play, right, front and center here a little bit. Even Bitcoin, a lot of people are now back bullish on Bitcoin.
No, absolutely. I mean, I think there are other things going on with Bitcoin, but certainly in this pocket of time, yes. Then if you look at a 30, 40, 50-year chart on gold, we tend to get right to these levels and don't quite break out. So we'll see if we can do it this time.
Interesting. All right, let's get into the 2023 financial conditioning. There's been loosening since March after Fed expanded their balance sheet to, thwart the regional bank. We'll call it a hiccup, I guess. And now we're seeing some tightening. The Fed needs conditions on the tighter side, but we're moving into a more art than science territory, which I think is always very interesting. And I think you have a tendency to believe speed matters here. So I'd love to have you opine on that.
Yeah, speed matters. It matters too for the rate hikes that we've seen. We've gone very, very quick and coming off zero interest rates, and that's why I think Chair Powell and the Fed is saying cautious here. But it's been a weird year, right? I mean, we started the year, people were in the recession camp. The economy proved much stronger than expected, where we did see the cracks, as you and I know, really on the banking side, the regional banking side. So with financial conditions, for the better part, really since late 2022, financial conditions were loosening. And then we had this hiccup in March. The Fed came in, they expanded the balance sheet. So that balance sheet actually started going higher again with the bank lending program. And really, since that happened, the market kind of ran with that and financial conditions loosened for the better part of 2023 up until this period of the summer to where we are now, where we've seen this dramatic increase in interest rates. So, I spent a good part of this year writing to clients that, look, I mean, the Fed, in some ways, with the emergency lending program, and maybe they didn't have a choice to do that, they were fighting their own cause of trying to tighten financial conditions. So I think the good news is, and Powell was asked about this in September, about the loosening in conditions. His comment was, look, ultimately things fall into line. Conditions have tightened. We're not quite at where we were at the peak of the tightening cycle with the Fed, but the speed in which we're tightening now, the speed in which long end rates are moving, although I think, like I said, the Fed needs conditions to stay on the tighter side to fight inflation, how quickly we move and whether or not that's orderly and how we move, I think does matter for this Fed.
Makes sense to me. All right, I'm going to do a little rapid fire. I'm going to throw like 5 or 6 things at you here at one time, and maybe if you could, give us your thoughts on all of them. Let's talk about the long end U.S. Treasury rates. Let's talk about the recent Fed speeches out there. You put out sort of a special mini paper, a white paper on Friday that we sent out to some clients. We got term premiums. We got fiscal spending. We got higher the longer end rates, replacing the need for more rate hikes. We got the fiscal picture. There you go. I threw a lot at you. What do you got?
Yeah, look, I mean, I actually I made a list. I thought maybe you'd come at me with this line of questioning, but if I were to tell you better growth, balance sheet runoff, Japan, the biggest holder of treasuries, changing their monetary policy, loosening their ban, so their rates are moving higher on the long end. China, the biggest holder of treasuries, no longer, more of a seller than a buyer here as they try and raise reserves. Fiscal deficits, we're running 2 trillion, increased volatility, global duration, not only higher for longer, but more restrictive for longer is what the Fed gave us in September with that quarterly projection. And then negative carry on the long end. I mean, there's not one variable there that spells lower rates in the end. And I think that's the pocket of time that we've hit. Speeches from the Fed, Dallas Fed President Lori Logan, I think she did a great job October 9th. She talked about term premium. Now, the Fed looks at it, look, if the market's expectations of what the Fed is doing, if that doesn't change and interest rates still move higher, which is what we've had, well, we're seeing term premium come back into the market. Now, who is the biggest influencer of term premium over time, Mike, in this pocket from 2010 to 2022? It's the Fed, right? I mean, we had negative term premium because you had that marginal buyer in every single day. So change in perception on the Fed. The Fed has said they can not only lower interest rates at some point, but they could lower interest rates and continue balance sheet runoff. We've seen a breaking down of correlations between treasuries and other asset classes. We've written about that. Stocks and bonds going down together. We've seen increased volatility, and the Fed is running off their balance sheet. They're no longer a buyer. These are all factors in the end that influence term premium. To the extent that term premium increases, and by late summer through now, 10-year real yields, inflation-adjusted real yields, have moved 100 basis points. That is a tremendous move. So what the Fed is saying is if term premium in the market is increasing, it could be, because of supply in the market, investors are demanding a little bit more in terms of what they're taking down relative to supply. That could potentially take the place of rate increases. And I think it's too early to tell. Powell will talk about this. I think what's key here is, do interest rates stay at these levels? Because what we've seen throughout this cycle is not only has the market underestimated the terminal end game for the Fed, they've also priced in rate cuts along the way. This is the first time that the market is finally saying, okay, Fed, you win. The data's cooperated. We're going to keep rates higher for longer, and we've steepened out the yield curve and the forward curve. So I think it depends going forward, but certainly I think the Fed is watching the long end very closely, and we're going to hear about that tomorrow from Chair Jay Powell.
Yeah, so let's tie this all in together. I mean, there's just so much going on. I think, if you look at what the pundits are saying, obviously, I don't think anyone has a cut tomorrow. And I think actually everyone thinks we're just going to stay right where we are. I think there's nothing that makes me believe we'll go a quarter point higher, although there was some talk about that maybe a month ago. What is the Fed saying about the economy, inflation? And, I think, you're making it clear it's going to be maybe the Fed's done raising rates, maybe, higher for longer. Is that the way you're still seeing it, full time here?
Yeah, I mean, I like the term maybe is the answer. I think a lot of people have conviction that they're done. What I would say is I do think the move in long end rates, and we've been sort of advocating that for quite some time, I do think that's important to the extent that, these real long end rates stay the way they are. There's no question in my mind, this third quarter GDP number, chuck it out the door. The Atlanta Fed tracker for fourth quarter is already way down. So that was an aberration. I actually think growth is going to slow. I do think there are lags with these rate increases. And I think the Fed needs to do what they're doing, which is stay tight. If the rate structure does continue to cooperate with the Fed, the market will do some of the Fed's work. But keep in mind, I don't think it's the market coming up with this idea. I mean, the Fed at their last SEP in September said, we're not only going higher. So it's not only higher for longer, it's even higher. And then they had inflation coming down in 24 and they took 2 rate cuts out. So that real yield as a function of mathematics, they had moving higher with inflation going lower. So even higher and more restrictive is what the Fed said to the market at the same time that the long end of the Treasury curve was already trading very weak. So I think they got what they intended to get. I think where they get a little nervous is when it moves really, really quick within a short period of time. And I think that has market participants nervous too, as does the fiscal side of the equation, which, the Fed won't talk about it as explicitly as we will, but it matters. And market participants right now are very, very concerned about the stock of debt that's coming out of Washington, not just now, but on a forward-looking basis in terms of 6% of GDP going forward. We are becoming much more sensitive on an interest rate basis to changes in the fiscal picture here and likely moving forward, in my view.
Makes sense. I guess I'll leave with this before we go. I guess there's always a scenario, but do you think it's plausible potentially, maybe I should have waited to our last meeting together to ask this, but I'll ask it again. Is it possible there's no cuts in 2024?
Oh, sure. It's completely plausible. If you look at, we have to figure out what's the last rate hike. Let's just assume the last rate hike is in the books. If you look at what they did in 06, 07 into 08, they kept rates on hold for 15 months. So that holding period, it does vary, is the reality, and conditions will change. So it's hard to make a definitive conclusion. But I would say, in answer to your question, is it conceivable that they stay on hold for all of 2024? And I think the answer is yes. And I also think there are certainly risks to the inflation outlook. And that's what the Fed is saying, going back to your other question, Mike. What are they saying about the economy? They're saying the disinflation process relative to economic growth, something's got to give. In other words, if the economy doesn't slow, this disinflation process that we had in 2023 could begin to reverse itself. Not only would that put pressure on more hikes, but again, it goes to this scenario of possibly even higher and longer.
Yeah, which is interesting. And I'll tell you, again, I don't pretend to know this stuff and study it like you do, but I do pay attention. I think Powell is very determined, and he will stick to what he believes is the right long-term plan, and he won't be convinced otherwise, if the data proves to him what he needs to do. But, I guess time will tell on that.
He has to win here. There's no question about it. Transitory was very costly, and it's kind of water under the bridge, but it's not. He has to win here. There's no question about it. So he's going to be careful because he knows they did a lot, but he's not going to give up the fight. We're not going to hear that tomorrow. They're as they say in Rocky, there's not going to be a rematch. There's no victory lap here.
I think they say it ain't going to be no rematch.
Right? It ain't going to be no rematch. Yeah.
All right, bud. Well, as always, I really appreciate you taking the time. I think, there's a lot going on right now, geopolitically and with the rates, and to sit here and kind of decipher through some of the stuff is extremely important. As always, if any of our clients would like to speak to Greg, please reach out to your representative. But Greg, this is, one of the most fun things I do. I appreciate you very much, and look forward to hearing from you after the presser.
Thanks, Mike.
All right, bud.